video, I'm going to talk about life insurance policy. There's non-forfeiture options, dividend options, and settlement options. So I mainly talk about non-forfeiture because I haven't talked about this before. Then dividend options and settlement option you can find it in other video, but I'm gonna compare them just so you know the difference between them. So non-forfeiture options is usually included in the life insurance policy provisions. So this is required by law because when a policy owner they bought a whole life insurance, they have the cash value, have the reserve. If they give up on the policy, so the law requires the insurance company have to return on some of the reserves to the policy owner. So you can see basically when the policy owner no longer wishes to pay the premiums on the whole life or other cash value policy. So you can see it's only on the cash value. If it's a term in life insurance, it's nothing. You have nothing if you stop pay the premium. They have three options when decide what to do with the value remain in the policy. So first one is the cash value. The policy is surrender and the cash value let of any applicable surrender fees and outstanding loans is set to the sent to the policy owner. So sometimes if your cash value is greater than the original your premium put in, you may have to pay tax. But most of the time it's less than your original premium. So then you don't have tax implication on this here. So the first option, basically you tax the cash value. The second option called reduce the paid up insurance. What is it? So the policy owner can also purchase a reduced amount of paid up insurance using the cash value as a single premium. The death benefit will be reduced, but no future premium are due. So this is a good alternative when there's still a need some reduced amount of the permanent insurance, but the policy owner no longer wishes to pay the premium. So basically, if you want to surrender, right? You surrender, then you have a significant amount of cash value there. They say, okay, if you don't tax the cash value, you can basically use the cash value as a single premium to buy a single premium life insurance policy. However, this the death benefit will be significantly reduced. So that's this option. So basically, say if you don't want to pay any premium in the future, you want a smaller amount of the death benefit. So this is something you can do. Then extended term insurance. So basically say the policy owner could purchase extended term insurance using the cash value for the single premium. The death benefit remains equal to the face value of the original policy, but no additional premium are due. The length of the time the term policy will last is a function of the age insured at the time and current amount of the cash value. Policy owner in need of the full face of the coverage, but for a shortened time frame and no longer want to pay premium would find this desirable. Basically, this what they do say, well, you have the amount of cash value. Let's turn this policy into a term insurance. Use your remaining cash value. you can buy the same amount. If you have $1 million death benefit, you can buy $1 million death benefit term insurance. However, how long is a 10-year term, 20-year term? It really depends on your cash value in it. So I'm going to show you an example. So every cash value of the life insurance include a non-forfeiture table. This table has 4 columns. So first is the number of year policy has been enforced. The second is the cash surrender value. So listed as amount of per $1,000 as a death benefit. So the third column is the reduced paid up insurance column, also as showing amount per $1,000 of the insurance. So another final is the extended term insurance column. So basically, we talk about the 3 options: cash surrender value, reduce the paid up insurance, extended term insurance column. So basically tell you that, hey, we list the 3 options here. You can think about it. Let's see an example. So basically you can see here we only look at the straight life. Then here says this is the cash value, right? Cash value. Then is amount paid up insurance. Then extended term, they have a year and the days. So basically say, well, example, you have a $200,000 death benefit policy here. So you already the policy in the term is already in a term is for 15 years. So if you surrender today, you want to take a cash value. Here there's a calculation. So if you want to take a cash value, you will get a $29,600. You take a cash value away. So that's it. Take a $29,600. You can take the cash value. Or you can do the option 2, reduce the paid up insurance. Say you can use this $29,600 cash value as a single premium to buy a whole life insurance, which is the death benefit is $74,200. So you can just say we're gonna do a reduced paid up insurance. So you basically when you die, you get a death benefit $74,200 with your $29,600. The single premium, the cash value as a single premium. However, just keep in mind this amount. So this is whole life, so will be to the end of your life. Probably this amount grow as well, since Then the third option say, well, you can use your $29,600 cash value to buy a term insurance, which will give you exactly the amount the death benefit current policy. So if you get a $200 death benefit term insurance, this will give you a 20-year term and 165 days. So those are those options. So basically say if you do straight life, okay, this is do straight life policy, then how you look at all those numbers, how those numbers being calculated makes sense to you. So basically that is the non-forfeiture option. You basically have 3 options: cash surrender value, reduced paid up insurance, and extended term insurance. So then we're gonna compare this to the life insurance dividend options and life insurance payout options. So life insurance dividend option, we learned that in other video is life insurance, if it is mutual life insurance, they usually pay dividend to you. So the dividend options, you have those options, it's 5 options. You can take a cash, there's no tax implication for you on that. Reduce the premium, there's no tax implication on that. Accumulated at the interest. So basically this one just say we're gonna put your dividend on a side so that your dividend will invested, you will have some interest on this dividend. In that case, the interest earned by the dividend is taxable. So this is the option. Paid up dividend addition. So this one kind of a little bit similar with the paid up addition with the previous non-forfeiture option, because this one is similar because you can use the dividend amount of money to buy additional whole life insurance, the tiny amount. So the dividend amount is a kind of a single premium whole life, because you don't have additional premium required. It's very similar to the non-forfeiture option because that is use the cash value as a single premium, so no additional premium required. You can see there. So the dividend option, you can have a 1-year term, so you can use your dividend to buy a year term life insurance policy. You will get a larger death benefit in that way. So you can see in previous non-forfeiture one, you can use the cash value to buy the same death benefit policy for a term insurance. So kind of, a little bit similar, but a little different, right? You see the difference, right? So this, you only allow like a 1-year term insurance. The other one, you can buy your death benefit is fixed, and the term is based on how much your cash value have, right? So that's the thing. So this is the dividend option. Then life insurance have a settlement payout. So basically say, when when the insured die, the beneficiary, this is to the beneficiary. Okay, think about it. For the non-forfeiture one, is to the insured. The policy owner, the insured, the option is available to the, to the insured. Then the dividend option is also to the policy owner, the insured. So you can see that's to the insured. The insured is still alive, right? So the insurance settlement option is basically you get the death benefit. This is the option to the beneficiary rather to the policy owner or the insured, right? So this is to the beneficiary. If you are the beneficiary of a life insurance, the insured die, you have all kinds of options to receive the death benefit. First one is very simple. Most people probably take this. Death benefit paid lump sum. So those paid to you is income tax free. So this death benefit. Interest only option. Policy proceeds kept in the insured and reinvest with interest paid to beneficiary. So this option, let's say you have $1 million death benefit. You say, I'm not going to take $1 million insurance, promise me, say, they're going to invest the $1 million. They're going to pay me the interest. Let's say they pay you, $40,000 a year interest. So they won't touch the principal. So in that case, you have to know this interest is taxable to you. So because this is not the benefit, not the death benefit. Death benefit is income tax free to you. this option you will be get taxed. Then fixed period installment, proceeds paid over a specific period of time. So this one, you may have a portion to be taxed. Just depends on how they pay you, because if they pay you more than the death benefit for the installment over the period of time, so you may be taxed. So then this one is a fixed amount installment. You can see the difference. Fixed period. Let's say you $1 million death benefit. Let's say they're gonna pay you for 20 years. 20 year is fixed. The amount of the benefit, so then maybe fixed, maybe not fixed. So the period 20 year is fixed. Then the fixed amount installment. So they will say, you know what, we're gonna pay you your $1 million death benefit. We're gonna pay you $100,000 per year. So this $100,000 per year is fixed, but the period of time is not fixed. So specific amount payout until the proceed plus interest exhausted. You can see, so how long you get paid is unknown. So that's amount is fixed. Life income options. You can insurance can promise you a life income. This is very similar to the annuity payout. So annuity payout option, you can get a straight life income. So basically, say your $1 million death benefit, we're gonna pay you $100,000 per year for the rest of your life. That's a very good deal. Then life annuity with a period certain. So basically, say $1 million policy, we're gonna guarantee you on 10 years, $80,000 per year. If you die within the 10 years, we're gonna pay the rest of the 10 years balance to your beneficiary. However, if you don't die, you'll get $80,000 per year for the rest of your life. The life income with refund. So basically, say your $1 million policy will pay you $80,000 per year. If you die the first year, at the first end of the year, you still have $920,000 balance. This balance is gonna be paid to your beneficiary. Then join the survivor life. So you have, two people that will pay you monthly income, whoever is survive. I don't know if this option available to the life insurance. Anyway, so fixed payment or fixed payment with the COLA inflation adjusted policy is very similar to the straight life. This one can be like a limited term, like for 20 years, 30 years, something like that. So anyway, so this you can see the payout option, right? This is life insurance. Life insurance. This is for the beneficiary. You can get the cash option, interest only options, fixed period installment, fixed amount life income options. Then you have the Then you have the dividend options. You have a cash option, reduced premium, accumulated added interest, pay up in dividend additions, 1 year term. So basically, you want to compare this ultimately to the non-forfeiture options. So you have the cash value. You can take the cash value. You can reduce the paid up insurance. You can extend the term insurance. Yes. Okay. So this basically it's very common in the life insurance. You have to come across to choose those options.